Hey everyone, Mortgage Nerd here. So interest rates this year, the beginning of 2022, have gone up over 0.5%, up to 1%, depending on your profile, the type of mortgage you're getting, credit score, all of that. That's a huge move. So the Federal Reserve, who kind of controls interest rates, but in some ways controls money supply as well, which then in turn controls interest rates, has been saying since last year that they're going to start raising interest rates out of fears of how out of control inflation is getting. Now, at first they were just coming around saying, hey, inflation is transitory. What the heck does that mean? Well, they were trying to say that inflation is just going to go up for a little while, and it's going to come back down, and it's not going to be that bad. Guess what? It's terrible. Every month it's 1% higher. 5% in October, 6% in November, 7% in December. That's a lot of inflation. Think about it. I had it in another video. If you have $100,000 sitting in a room, 7% means at the end of the year, you just burned $7,000. You don't have it anymore because your buying power has gone down by 7%. Now, this is only based on the Consumer Price Index, the CPI. That's a basket of goods. So think of goods, you go to the grocery store and you put them in your basket and they've gone up 7%. This does not include cars. It does not include boats. What about real estate? How much has your property appreciated in the last year? I mean, it's gotta be a lot. 30% here in South Florida. Other places, not as much, but still double-digit inflation. Remember, inflation is theft. I've brought this up in other short videos. You don't want inflation to happen. All right, so the Fed is done saying, hey, it's just transitory. Now we're actually gonna, believe that it's here and we're gonna take some action. What actions are they taking? Well, there's two levers they can pull, two things that they can do to try to fix this situation, because they printed enormous amounts of money thanks to the last two presidents in this pandemic saying just print money, it's okay, right? No, it's not okay. So they have two levers they can pull that they can just say, this is now going to influence interest rates, it's going to raise interest rates, and therefore it's going to bring down inflation, or so they hope. One of those, the one that they directly control, is the Fed fund rate. That's the one where they come out and they say, hey, we're going to lower the Fed fund rate to stimulate the economy, which they already did. And now they're going to raise the Fed fund rate because they want to slow inflation. All of this started happening in the 1970s and kept going in the 80s and 90s. So it's fairly new, all this manipulation of the markets, as opposed to letting the recession come or the depression come and things kind of fix themselves. No, they want to manipulate it, and it's only making things worse in the long run. Either way, those two levers, one, they're controlling that interest rate, they're controlling the Fed fund rate. That's your adjustable rate mortgages. They're not going to change that until probably March. That's one. The other one is buying of mortgage bonds. So when the economy started going down, pandemic started, they said, we're not only going to drop the interest rate, but then we're going to buy billions and billions and tens of billions of dollars a month in mortgage bonds and other corporate bonds and things like that. That props up the economy because people weren't buying bonds. The government was buying the bonds by printing money to buy those bonds, just like they printed money and they sent out the stimulus checks. By doing this, they stimulated the economy, they kept rates low, and it's called quantitative easing. Now they're going to do the opposite, and they're tapering. They are going to reduce the amount of bond buying. And this has already started. This started in Q4 of 2021, but now we hit 2022. They know this lesser or smaller amounts of bond buying is happening, and so the rates are skyrocketing, 0.5% to 1% in the first couple weeks of January. So now the Fed is going to start those two things, and maybe it's going to help. Now, one thing that is going to help is when they raise that adjustable rate, there's this thing that's going to happen. Someone was telling me I was wrong in a video. When they raise that adjustable rate mortgage, the inflation fears are going to slow. So the bond buying is going to come back, and that is going to bring long-term mortgage rates down. So let's see what happens in March and April, because rates are going up and then they might come right back down. Not to where they were in 2021 and definitely not 2020. We'll see those again next time there's a recession, which I'll have other videos on recession indicators because they're coming back. And I had videos on this in 2018 and 2019, and in the end, it was right. Mortgage Nerd out. Thanks.